Welcome back, everybody. I got Tony Piraino with us, and we're going to talk about market trends right now, some tax strategy stuff, making it clear we're not accountants, but we are going to share what we have learned over the last few years, especially, at least for me, it's really been a learning curve of the last probably 2 years of really being strategic about our tax planning. But Tony, take it away with what the trend is locally, and are you seeing anything broader than locally with the real estate market?
I look at this every morning. That's the first thing I do. I'm kind of a nerd when it comes to stats. So I'm putting it, I've got my spreadsheet open. I'm putting in the local market stats. I'm always looking at Macon County because that I got to narrow down somewhere, and it's pretty reflective of the rest of the Central Illinois area. Nationally, things are different. You hear different stories nationally, but at least here, what affects us. I look at a few things. I look at active listings, pending sales, number of houses sold, and then I look at one metric that I look at is called month supply of inventory. And so I've got that daily chart since I started tracking that middle of last summer. Our month supply of inventory, which really what that means is how long it would take the number of houses we have in inventory to completely sell if we were selling at this rate. Okay. So if nothing else came on the market and we continued at this rate, how long before everything was sold?
Right.
When I started tracking it, it was 1.16. So in just a little over a month, if no more, which is very low. In just a little over a month, if we didn't get new listings, which listings are hard to come by right now, everything can be sold.
Right.
So to give you an idea, anything under 4 is considered a seller's market. 4 to 6 is considered a neutral market, and 6 and above is considered a buyer's market. Since I've been in real estate in 2017 as a real estate agent, I've been an investor longer than that, but It's always been a seller's market, but it's a very strong seller's market. And that's about where we had been for quite a while. Then something interesting happened in the middle of September. A lot of new listings did start to come on, and buyers just started dropping off. I don't know if it's just a seasonal thing. Right. Interest rates were higher for sure.
This past September?
Yes. Yeah. And I look at, so in addition to month supply of inventory, I look at where are the pending sales versus where are the active listings. And we were always higher we had more pending sales than we had active listings by about 30 or 40 more pending sales than active listings. Well, that started to flip in a big way, actually. So at the time when I started tracking this daily, we had 170 pending sales and only about 140 active. But then I think it reached its worst point January 1st, where we had like 170 active listings, which is still really low.
Right.
And we got down to 70 or so pending. So like 100 pending sales swing, which is quite a bit. And everybody's feeling that too. Ever since then, it has started to track back up, and now we're above. We got more pending sales than active listings. But yeah, it was a slow start to 2026 for sure for everybody. But that's started to pick up. We are seeing new listings coming all the time. Our month supply of inventory had gotten all the way up to 3, so still a seller's market. It didn't reach that 4 threshold, but it's back down to this morning. It was 1.24, so
it's
pretty
strong seller's market.
Pretty strong seller's market. Yeah, there's just not a whole lot out there. Not as many buyers out there right now, but the ones that are out there are having a hard time finding something because there's not much out there.
Do you think it's more like somebody buying to live in or investors? I mean, because I feel like I hear of a lot of investors that are still trying, but maybe less homeowners. Is that what you're seeing too?
It's a good, solid mix. And we do for sure get a lot of out-of-area investors, a lot of local investors. Right. People are always asking me, who's buying these houses, right? Everyone's leaving the area is what people think.
Right.
And sure, there are people leaving, but from what I see is there are people moving back because they've tried moving in a different area. The grass is always greener on the other side sort of thing. Florida, they get tired of the hurricanes. And so I hear that. People are telling me, yep, we've been in Florida, we're coming back. Tired of the hurricanes. Yes, property taxes are better, but there are other things that get you on down there. So,
right. And I think, we've had this conversation before too. At the end of the day, it's easy to say I want to move to Missouri or Tennessee or whatever where the taxes are. At the end of the day, they're getting you in different ways, right?
Yeah.
I mean, property taxes are a big deal for us because
yeah.
we're seeing that seller's market really. We're seeing our
EAV.
the EAV go up so much over the last 4 or 5 years.
Yeah.
That it's just. I mean, the assessors are really hammering away.
For sure. It's good for our net worth, really, because it helps. It helps
and
with that
borrowing power.
Yeah, that's true. Yep. But then you're right. We're getting higher property taxes that we have to pay, especially when you got a bunch. You get a whole folder in the mail with the property tax bills. That's coming up soon. Ugh.
I know. I mean, and at the end of the day, that's what I mean. People are like, well, why are rents just climbing so high? And it's, I even explain it to our tenants when they ask. Say, well, look, the property taxes on this house were this much 3 years ago. Mm-hmm. Look at where they're at now. The insurance I was paying was this much.
Too, yeah.
And now it's this because we had some hailstorms and some windstorms over the last couple of years. The Midwest insurance companies as a whole have hammered us with, double-digit percentage increases across the board.
Are most people getting that when you tell them? Or
most of them are.
Yeah.
Yeah. I mean, I think if you're transparent, I'm just like, look, I'm just trying to split the difference with you. It's not like I'm trying to even pass the whole bucket.
Yeah, we're not even trying to get more profit here. We're just trying to.
I'm trying to, and I always try to keep it reasonable. A low percentage. If it's $1,000 a month, and I'm only raising your rent $25.
Yeah.
Obviously, I'm doing my best.
If they owned that home, they would see that same increase.
Right. They would see it more because it is hard to pass on $80 to $100 a month onto a tenant that was paying $1,000 already.
Yeah. For the most part, people get it when I have that conversation, but I did just have somebody that was, put their notice in that they're going to be leaving because they didn't want to see any sort of increase. I'm like, okay, well, good luck, because when you go buy something, it's going to be worse.
Right.
But also, I'm not sad about it because they've had that rent locked in at a low rate for so long, and now, like you mentioned, the rents have gone up, so I'll be able to get more now.
Yeah, we have 3 that are vacant for May 1st, and one of them we increased $200 a month.
Yeah.
So we were not disappointed that they wanted to move. And at the end of the day, a lot of them I've had some tenants that have given notice, but then turn around, hey, never mind, I don't want to move.
Yeah, when they start looking.
I'm like, well, that's because you went looking, and you're starting to see, wait, I am. Even with a $25 a month increase, I'm lower than if I leave.
Yeah, as low as the inventory is for buying a home, the inventory for renting has got to be worse.
Yeah, we get requests all the time.
Yeah,
and most of the time we just don't have anything open, or it's just not exactly what they need.
Yeah, that too. Yeah,
because it always happens. Someone that needs a 1-bedroom, all I have is a 3-bed house open. Yeah, and vice versa.
Yeah,
but that's the way it is.
Yep. So really, that's what's going on in the market. Interest rate has gone up a little bit because everything going on in the world.
Yep.
I don't want to get political, but things happen, and that has an impact on our purchasing power. So it was trending down. It was getting down to the 5s again, which is great.
Yeah.
But now we're more like 6.5, depending on people's credit scores and things like that. So. I do see that going back down. That will help.
And people. I was feeling encouraged when I started seeing some 5s again.
Yeah.
But I don't know about you, but for the first probably 8 years of investing, 5 to 5.5 was where we were at almost all the time.
Yeah.
6 to 7 years ago.
Yeah.
And that was fine.
Yeah. That's part of the inventory issue is you got these sellers that are locked in at, I see it all the time, they're at like 2.5%. Right. And they need something different. Their family has grown, or they need to downsize, or they need single level, but they just, and I don't blame them, don't want to give up that 2.5%.
Right.
I think Trump threw out something about locking in that interest rate and going to at the new house.
Oh, yeah.
He threw out this idea. I haven't heard anything about that since then, but interesting idea because that would for sure open things up for a lot of people. There'd be
a lot of listings at that point, I feel like, if you could carry over a rate.
I think the floodgates would open, but I do not understand how that would work
how
for lenders.
Would that actually, how does that math out?
Yeah. Interest rates do go down. I do think that will, which is kind of why I was surprised in January when things weren't a little more popping, because the interest rate was lower then.
Yeah,
but
better than
I think it just had to do with post Christmas, people recovering from that, and but it's taken off I would say mid-February, it's started to really feel back to normal where it was. Actually, last year was a record year for myself and our whole team and a lot of people. It was just a really busy year for real estate. So then it just dropped off from September to January. So we're like, what's going on here? But
it's starting to bounce back.
Yes, for sure.
Do you think the investment property side is going to level out at all? Because, I mean, you used to be able to...
Price is going up.
Yeah, I mean, the prices, even for a small rental in South Shores, you know, we looked at one last week. I mean, that used to be listed in the upper 40s, lower 50s.
I don't know, though, because of how high the rents are, that justifies it, and you can make that higher price work. So, no, I don't think... I mean, you and I are both still looking, despite the higher prices. So, And I think most people are. People are starting to build now again, and because there's incentives out there, which I suppose we'll talk through. But, so I think that'll still be there. And, we were talking about this earlier, but I see people coming here all the time from different investors or just coming to live here. So it's not the mass exodus from Illinois or Decatur like you maybe hear on the news or on social media.
Right. Do you think that it's going to continue that trend of just people
coming back here?
Well,
I don't see a reason why it wouldn't, because the major employers are hiring. There's small businesses. There's a lot going on in the retail side too. Pretty exciting to see all this stuff happening in Forsyth, including with you guys. I don't really see that changing. There's no indicators anyways that things are going to go a different way here.
Right. So it's just kind of misleading when you read all the social media stuff, and it's just, people might, I mean, overall, I'm sure Illinois is still losing population, and those statistics are out there, but maybe our area is not feeling that burden as much as certain other areas of the state.
That's not what I'm feeling. That's not been my experience anyways.
Right. And do you think that it's going to keep trending with it just staying a seller's market? Any reason why you wouldn't think?
No, unless the interest rate were to skyrocket, but that's not what they think is going to happen. That's not the indicators that they're getting. So if it stays where it's at or even goes down, I do think that'll just make it an even more competitive market. Yeah,
I agree. I mean, especially the small towns.
Yeah.
I mean, there's not a ton of listings in Forsyth.
Nothing, and
whatnot. I mean, it's just...
Yep.
It's slim.
Yeah, we just came back from a team meeting. We're all talking about the stuff we're looking for. And it's like, well, we've got listings coming, but not what our particular buyer set's looking for. So,
is it still a lot of looking for a ranch, looking for a...
Ranch is always going to be more appealing. Because people want single level.
Right.
Just as they age into that type of home, that's what they need. We got people looking for houses with pools. There's very specific things that we just don't have coming right now, unfortunately.
Right, and that's not a cheap thing to put in,
right,
or maintain. That they will find out. But
true.
So shifting to
tax day.
Yes, it's Happy Tax Day.
Yeah.
Some strategies, and I know I don't know if you're okay with sharing a little bit of what you're analyzing to potentially help yourself tax wise, because it's something that I have done obviously already too, and building and just the way it kind of works, and those advantages that we're looking to take. To capitalize on.
I'm happy to share on that, and a lot of it I learned from you, honestly, in this regard. So, you guys did this, and I'm just kind of following your model on this one. Even the plans you guys use, but you built in Maroa, and I'm gonna build in another area, or I'm trying to. But really, right now, just with the one big beautiful bill, whatever, however you feel about that, there were a lot of tax incentives that went in with that.
Yes.
I take every year, there's a guy named Chris Bird, who is a former IRS auditor who has his real estate license. He's an accountant, and he puts on this class for real estate agents. And I learn something every time going to that, and I take pages and pages of notes. And it's all about what do the latest tax laws, how do they affect real estate investing and real estate professionals? And one of those is this commercial building sort of thing, or multifamily, and what you can. It's just I'm going to get it wrong, but it's basically a what am I saying? Depreciation, one-time depreciation, upfront depreciation, which can be very impactful for your income taxes.
Right, you're not forced to do the 27.5 year. or is it? It's 15 and a half, I think, or
With
something like 15 or something like that on new build.
Yeah.
Right. New constructions.
Yep.
15, I think. But you can actually take all that depreciation
up front.
Well, yeah, all the non how is it worded? The non structural things.
Yeah.
You can take that depreciation all up front as opposed to deferring it all
over a longer period of time. Yeah. Oh, you said this up front, but we are not accountants.
Yes,
this
not
is
accountants,
not
not
financial
tax
advice.
Yeah. This is do your research.
Yeah.
We both have heard this stuff on many podcasts ourselves.
And taking classes.
And taking classes and consulted accountants and attorneys. And then, like you said, last year I put it into practice. And the benefits were, it was true. It was, it worked the way. Yeah, and it impact, what we had to pay to the IRS in a good way.
And on top of that, doing it in a place that has a tax increment finance district, TIF district.
Yes.
So I'm sure people have heard that, but just to try to explain that at a high level, you've done way more of this. So just me going through this currently, I've got a pretty fresh perspective of it.
Yep.
So the whole idea is that these villages put in, they approve these TIF districts. And the idea behind a TIF district is to improve blight, really, to encourage development that might not have happened if there wasn't an incentive there. Right. So a TIF district, which ideally would be to fix up something that is dilapidated, give it some new life, or for an empty lot to encourage development. So what happens is they look at what the assessed value is of the current assessed value of the property in its current condition, and you get going into an agreement with the entity, the village, and it says that if you increase the assessed value of that property by X amount, then that's the incremental tax that will be received by all the different taxing entities. And that will go into our TIF fund, but we'll reimburse you on an annual basis up to a certain amount based on the qualified expenses. And that can only happen if you actually increase the assessed value of that property. Right. Which is what they're trying to do. Right now, it's an empty lot. It's getting empty lots get nothing in tax and property taxes. So the schools, the fire protection district, the roads, everything gets nothing from that basically. So if a developer goes in and puts a large gym on a piece of property, now all of a sudden when that gets reassessed after the completion of that, there is going to be a huge tax, unfortunately, a very
large. That's why the TIF is needed, though,
because
that's right. Construction costs so much, especially right now.
Yeah.
To sit there and say, okay, we're going to build this new building and run this new business, or rent out these new units, but then get this big property tax bill as well.
Yeah.
The numbers don't. Yeah. The numbers just don't work.
Yeah, I think in the area that I'm looking, based on what I estimate the assessed value will be of the quadplex, it'll be $15,000 a year in property taxes. Right now they're getting $300. So that's $15,000 in property taxes that those entities were not seeing anymore. So basically the village then will write up an agreement, it'll get signed, it'll be recorded, and it'll say that we've already agreed that these are the qualified expenses that can be reimbursed, and by that $15,000 incremental tax per year, a certain portion of that can come back to the developer to help make it make sense. Otherwise, there's no way the numbers would make sense. Because it needs
to cash flow for you. Otherwise, why would
it's hard to cash flow on a new build.
It is.
So TIF and then the escalated depreciation.
Yep.
Those are the two things that make sense. So I'm in the process of working that. You've already done it. Maybe do it again in the future.
Oh, yeah, definitely.
Yeah.
It's one of those things where it makes so much more sense why I see so much development in other areas.
Yeah.
Because here it's starting to happen some, but I see it. You see in so many areas. I'm like, how are they doing this?
Yeah.
It costs so much to build. Then when you look into the incentives, the TIF, and then the escalated depreciation, makes a lot more sense because there's other ways to make the numbers work and save money. Because if you just crunch the numbers on that quadplex,
there's no way.
You're probably having to charge over $2,000 a month for each unit to make the numbers work, and then that is too high. It doesn't.
Yeah, and like we talked about, it'll be a nice rental option for people where there's a very lack of supply for
Yes.
quality rental options. So yours have stayed pretty full, right?
Yeah.
Yeah.
We've been full. I mean, the first month we finished, we filled all 4 units,
Yeah.
and they've been full the whole time
Yep.
since last
Awesome.
August.
Yeah.
So I mean, it's
So you guys just get this gym behind you so you could
get the
keep
get the
going
gym
on.
done.
Yeah.
But once again, that's something that we're able to that we wouldn't have been feasible without the TIF.
Yeah.
In working with Forsyth to make it happen. You know, it is a partnership, but it makes so much sense from a village standpoint because, like you said, if you're only getting a few $100 for some
Yeah.
land, and then that assessed value, you start getting $20,000 a
Yep.
year. Even if you go to the max and give 90% of it back to the developer for the life of the TIF, if there's say 15 years left.
Mm-hmm.
For your village long term,
Yeah.
you're setting the village up to be in a way better spot down the road.
And even better if you can get a developer to rehabilitate something that's just sitting
Sure.
there as an eyesore or a safety hazard. We're looking at in another community where there's a building, a pretty nice big brick building that has been, the assessed value has been lowered to like $35,000 now just because it's so dilapidated and needs so much work. It's in the TIF district, so with TIF funds, we can rehabilitate that and get that not only assessed higher, so all the entities are now getting more in tax dollars, but it's an asset to the community and not just sitting there as blight and the main thoroughfare. So they give you, there are more qualified expenses if you're doing a rehabilitation versus new build.
There are, yes.
Yep. So I assume I saw Forsyth just announced several new things coming. Chick-fil-A, you can see that as you're driving through here. Is that in the TIF district? I assume there's some. Yeah, okay. I assume everything that they announced was within their TIF district, and there's some funds there.
Yeah, I mean, which makes total sense
Yeah.
for those entities that are looking to come to Forsyth to be able to do something like that.
Yeah.
Have an incentive that helps make everything work.
Yeah. Well, then I made a mistake of reading the comments, and I get so frustrated because you see in there like, why don't you?
It's all negative.
Like, you should be happy about this. This is positive change.
It's all negative.
A building that's sitting empty. Like, why doesn't the village rehabilitate the theater? Oh, I'd love to see an IMAX in there, but the village isn't doing this. They're just providing the
village does not own the movie theater. The movie theater.
Yeah.
And there's only so many incentives they can give. I mean,
yeah, kudos to them, though, for the village for making all that happen because they're in competition with other entities, other villages, other neighboring communities, and just trying to sell the community and making it so that those, like a Chick-fil-A, wants to come here. I remember for the longest time they would do surveys. I think it was the city of Decatur was doing surveys on what restaurants people wanted to see come here, and it was Chick-fil-A and Chipotle, and I mean, repeatedly those two were brought up, and now we're going to have, I know,
we're gonna
not
have
both Decatur, one Decatur and one Forsyth, but it's the greater community is
getting exactly what they were asking for.
Yeah.
It's just,
but you'll still have naysayers like, it's got to be. But we're also getting a local family doing Diamonds is moving into the old Crab Lobster, so that's exciting.
And that's taking care of a building that has been
empty,
vacant off and on for many years at this point.
Yeah.
So it makes a lot of sense, and those incentives are there to make that stuff happen.
Yeah. And what you're doing with the gym, that's gonna promote people wanting to develop out in that area too.
Right.
And
that was the whole goal. I mean, build this road out here and put this brand new facility, then other things will want to start coming out there, and that can hopefully become just a whole new development that.
It will. The building looks beautiful too, by the way. I love it every time I go by.
Yeah.
My kids get tired of me pointing out that's where the new gym is.
Yeah.
We know. We got it.
It's exciting, but it's been so many years of build up. It's just I can't wait till it's just done.
Yeah.
Are there any other things that you're working on from a real estate investor or just agent aspect that you've been working on or through?
Or helping clients do.
Or whether it's a tax benefit or not.
Yeah. Let me talk about one that I just learned recently, and I'm kind of ashamed that I didn't know this, but actually as I talk to other investors, it seems like this isn't well known, is this 1 year plus 1 day rule. And so for people who flip houses, this is key. If you're buying and holding for rentals, this really wouldn't affect you anyways. But for people that are flipping houses, if you hold it for a year plus a day and then sell it, the gains on that is taxed as long-term capital gains. If you do it for under a year, it's taxed as ordinary income, which is significant. I've got somebody right now who bought a house for like in the $30,000 range. They're doing all this work to it and going to sell it in the $200,000 range. Well, they're going to do it all in under a year, which is great, except that that's all going to be taxed at the ordinary income rate.
So does it make more sense to wait?
Oh, yeah. And it's significant. So for them, it was going to be like it was going to make a difference in like $20,000 worth of taxes just because they did it quickly versus, and I'm doing the same thing because we flipped the house and we're getting ready to close on it May 1st. And I didn't know of that or didn't appreciate that until I took this Chris Bird class. And now I'm like, if we do another one, we're just going to rent it out for a year or so and then flip it. I don't want to flip and then rent.
So I mean, I just got lucky then on the house we did in Forsyth because we did start it.
Yeah.
Well, we had to wait 6 months to start it because we were already doing one.
Yeah.
But then we had to pause because we had bought a couple more
Other
buildings
stuff, yeah.
and everything. So we made it over the year mark, but that was not by design. So
Yeah.
that is good to know because
Yeah.
I did not know that.
Right. I find a lot of people don't. It seems like that would be a
No,
little
that makes
more
a lot of sense. I mean, like
well-known.
we're working on one now, but all I have to do is get to like August 1st or
Yeah.
something, and it'll be over a year. So
if you're close too,
yeah, and we just started working on it. So I
Yeah.
mean, we got at least 2 more months of working on it.
Yeah.
I'm not going to rush it now.
Right.
Because I can.
But that'll be my strategy going forward if we're getting something. Most of the time what I'm doing is buying to hold to
Right.
have as a rental. But a friend and business partner and I, we do flips, maybe 1 or 2 a year. But we're going to start where we rent it out for a year and then,
Yeah, that makes sense.
and then rehab it and sell it.
Nope, I mean, that makes a lot of sense.
Another way to avoid that tax is by a 1031 exchange. Have you done one of those?
I haven't done it.
Okay.
When I've talked to my accountant, for the smaller things, he's like, there's not – that benefit is, yes, it's there, but it's really for like if we ever want to sell one of our apartment buildings that we've had for 10 years and we've depreciated on it.
Recapture all that.
He said that will be – you don't want to – that would be a good one to – 1031 exchange because you don't want to deal with. I mean, that's a lot of tax to take on.
I've done one personally. One time, I've had investors do them. I thought about doing it on this flip, but I don't like it. So here's the thing: is 1031 exchange. The name comes from the section of the tax law, and you're not eliminating. So I guess back up a little further. The capital gain. Goes into this 1031 exchange, and you're deferring that tax, that capital gains tax.
Right.
You're not eliminating.
You're just kicking it down the road.
That's right.
You're not getting rid of the tax.
Yeah. Yep. I guess maybe a way to get rid of it completely is to just to give it away as an inheritance, and maybe they then
right. At least everything I've listened to, it's basically when you die, it does technically die with you. That tax does.
But
for now,
yeah.
let's be honest.
That's
that
true.
probably will not be the case forever.
But what I didn't like about it is that I always thought that just the profit would go into this. Like you have to identify a property and reinvest that into a qualifying property within a certain amount of time and then buy that property by a certain amount of time in order to defer. Well, I always thought it was just the profit, but it was the whole proceeds. So that all that money was tied up. We had to use that money to buy the next place. And like you said, eventually we're going to sell and going to be obligated to pay that tax burden anyway. So I don't really like it, but that is a tool out there that some people, especially for something big like that.
Yeah. I mean, I have not done it, but I think that's only been because I haven't.
It hasn't been a huge.
Yeah, I've been instructed, hey, that's not going to.
Yeah. Just
pay the tax. You're better off having the money at this point.
That's true.
But for just a single family home, that's what.
But apartment buildings or
something, especially if you've had it for a long time and you've really depreciated it down quite a bit.
Yeah. I think that understanding isn't there with a lot of new investors. The whole idea of depreciation is great, but then if you go to sell, like some people are like, oh, I want to sell this and do something different, you have to recapture all of that depreciation. Even like a vehicle you've bought as a business expense.
Yep.
Like my truck has been fully depreciated. So if I were to go sell it now, that would all be taxed as income because I'm
Right.
recapturing that. So, not ideal.
Again, get somebody you trust, a
Yeah,
good
an
accountant that, especially if you're really diving into real estate.
Yeah.
I mean, your accountant can make or break how much you pay in taxes.
Yep, for sure.
So much.
And your understanding of it too. Like a good accountant will actually sit down and have consultations with you and
Right,
explain
and say,
things.
hey,
Not
this
just
is why
Yeah.
you should do it this way as opposed to this
Yeah.
way. And it is always good to be listening to podcasts and listening to stuff and bringing stuff to your accountant and asking them,
Yeah.
hey, why haven't we thought about this? And I mean, occasionally he might say that's actually a good idea.
I did that actually.
Yeah.
Because at that tax class I had, he said, ask your accountant these 3 questions, and I did. At the very end, after we did our consultation, I did, and 2 of them, he said, yep, we already got that covered. And the 3rd question was, how much can I put into an IRA this year? Because you could still contribute to the IRA this year. And what's the maximum I can contribute? And what will that do to my tax obligation? And he said, that is a great question. Actually, let me see. If you contribute X dollars, you're going to save this much in income tax. I'm like, oh, that's a no-brainer.
Yeah,
I'm either going
great.
to spend the money in income tax or put it into my retirement. So we did that, and that was So go to the classes, learn the stuff, and then ask
great,
them questions.
because I've had that happen where I've brought stuff up to an accountant before and said, let me look into that, or I haven't heard of that. And I mean, heck, they're busy too, right?
Yeah.
So I mean, you want one that's doing the continued ed, but at the same time, there's going to be things where
you're going to hear
you might just hear it, and more often than not, they're going to either say they have a good accountant's going to say I already have that covered, or it doesn't apply because and they explain it to you.
Yeah. I think one of the questions I had was like this whole R&D. Like you can R&D, you can get a tax credit for research and development. And my accountant's like, no, you're not doing any R&D, so we're not even going to try to go down that road.
Right.
I appreciate him trying to keep me out of jail too.
No,
Sometimes
exactly. Have you ever asked your accountant? So what about the Augusta rule?
Actually, that was one that I was going to bring up. You've heard of the Augusta rule?
Oh yeah.
What did your accountant say?
He said there's a fine line. Potentially, I could get I do have a decent amount of qualifications to justify it.
Yeah, I would think you would for sure.
But that was also before I switched. So now I need to bring it up to the newer accountant and see what he says, because I was like, well, I mean,
renting out your house or your machine shed, right?
Yeah.
You have that finished space in there. So yeah, Augusta rule for people listening that haven't heard of it. I'm told in this Chris Bird class I took, he said it was named after, I'm not a golf guy, but after,
Augusta, the Masters.
Augusta, because these golf pros go into town, need to rent a place out for a couple of weeks, and the residents were getting huge income. So the whole idea is you can rent out your home or second home for up to 14 days per year, and that is tax-free money. And that's a business expense for if a business rents it out. So someone could, in theory, rent out their machine shed to their business could rent the machine shed from them personally, and that's a business expense for their corporation and untaxable income.
Retreat,
team meetings, strategy sessions,
all that.
Client parties and all that stuff. A big 4th of July party or something.
Yeah. Right.
So you could do that up to 14 days a year, and it needs to be reasonable. So
right.
My accountant, he did say, yes, you could do that. It needs to be reasonable. So do your research on what similar size spaces rent their places out for by square foot, and look at what square footage you have, and do it that way.
Yeah, I'm definitely going to look into it for
sure.
For next year,
Or you could, Farm Progress Show. Is it back here this summer?
I'm not sure.
I don't remember. I didn't make it to the last one. But anyways, I feel like you could rent out RV space for all the people that come into town, or and then that would be tax-free income for you.
Right. Yeah. There's just so many different things. But at the end of the day, the reason why I started diving into it more, and I'm sure you too, is you hear of all these ultra-rich that, they pay no taxes. They pay no taxes.
Yeah.
Or little taxes. It's like, okay, well, why am I paying a crap ton then?
Yeah.
And figuring out that, all this stuff exists, and they're making, at the end of the day, they're playing chess while most people are playing checkers.
Yeah, that's true.
Is what I found.
Yeah.
And that's what it comes down to.
Yeah. Another one that you turned me on to is the idea of doing a cost segregation, and that really is for multifamily. And is that essentially what you were doing with the new build, the quadplex?
Yeah, I mean, there's that bonus depreciation in there
Yeah.
from the big beautiful bill, but then there's the cost segregation part. It's kind of all mixed together. But the cost segregation that we've really done has been like on the apartment buildings we bought in Mount Zion,
Yeah.
and stuff like that. It's been real easy to do a relatively simple cost segregation on like a pretty cookie cutter apartment building
Yeah.
to get extra depreciation.
So there's a cost involved with that.
Right.
You got to pay for them to do this cost segregation, but they look at for that building what all is stuff that could be depreciated in the first year. Just speeding up that depreciation so you can take that tax.
Yes.
Yeah, in the first year. Let's see. This is something that comes up all the time. I have this conversation with people that move out within a couple of years or right at 2 years. Are always asking, well, the market has gone up, so am I going to have to pay a big capital gains tax on their personal residence? Yeah. So the way it works is if you've lived at the home at least 2 out of the last 5 years, you can make a profit on your home and not pay a capital gains tax up to a certain limit.
Right.
And in our area, the limit is so high that you're not going to see it. So for a single person, I think it's $250,000. You can make $250,000 in the sale of your primary residence and not pay a capital gains tax.
Right.
For a married couple, $500,000. We're not going to see that in our area.
Right,
It's going to be like California or Florida or something. But a lot of people don't understand that. So as they're talking to me about selling their home, like, I need to wait because, or I really can't sell my home because of the capital gains tax. I'm like, no, you've been at 2 in the last 5 years. You're good. Right. You're not going to make a $500,000 profit on this home.
Exactly.
And even for the person who's been there just under 2 years, I try to explain to people that, yeah, maybe you bought the home for 100 and you've fixed it up, and so now we could probably sell it for 175. You're not paying a tax, again, not an accountant, but on that $75,000 because you've put a bunch of money into this house. You've done things. If you've kept good records of that, your accountant will adjust the cost basis of the home to offset that. And even closing costs from purchasing the home and selling the home, those go into that to offset this. So, yeah, I think that's property taxes in general, people don't understand. So I kind of nerd out on that when I talk to people because I hear that all the time. Someone will tell me, oh, I don't want to buy a house in so-and-so or like Forsyth, Amaroa, or Mount Zion because I can't afford the property taxes. The tax rate's so high, they tell me.
Yeah.
Like, actually, did you know that the tax rate is lower there than this other area? And it's because the value of the home is higher. But if you're looking at this price of a home, whether it be there or here, you're going to be better off in this community than that community because of
the tax rate is actually less.
Yeah, they don't understand that, or they'll say, oh, I can't afford that house. It's on the lake. The taxes will kill me there. Like, the tax rate is the exact same at that house as it is at the one across the street from it. The value of the home is higher, but if that's the price of the home you're looking at,
then that doesn't matter.
That's the taxes are based on the value of the home.
Right.
So
yeah, I do think that confuses people a lot of times.
Very much so. Yeah. But I get it. I don't think I understood it before I was really
I mean, at the end
stuff.
of the day, I mean, this is you and I are talking about years of being in the real estate world. As opposed to, I mean, I'm
dabble in it.
Yeah,
buy a house once every 7 years.
Yeah, exactly. The typical homeowner, that just is buying a place to live for however many years and then moving and trying to navigate if they have to pay capital gains or not.
Right. There's another one that you and I have talked about is homestead exemption. So someone that lives in their home, they're up to one residence throughout the country, they can get a owner-occupied exemption, which will reduce the assessed value of their home by $6,000. And depending on the tax rate, that works out to be about a $300, $400, $500 a year property tax benefit. That's for your primary residence. However, and there's also senior exemption. So if you're 65 or older, that will reduce your assessed value by $5,000. So about a $400 property tax benefit there. There are senior freezes. If you are under an income limit, then it freezes the value of your assessed value. So even though everybody's EAVs are going up around you, your assessed value is going to stay where it's at, which is very helpful when EAVs are going up right now. And there's veterans exemptions depending on the disability.
Right.
I've helped a lot of veterans who are at 70% or higher. We just had a 20-year war, so there's a lot of veterans out there who
Right.
have been deemed 70% or higher disability. Thank them for their service, but then also make sure they understand that that means that they won't have to pay property taxes at all, which is
Right.
which is a great benefit and deserving benefit for them.
Yeah, it is.
Yeah.
It is.
But also for investors, we can get a homestead exemption if we meet certain criteria for our homes, and that they've made it a little harder.
They have. Have you dabbled in it yet?
Yeah, I have. I haven't completed them, but it used to be that you just have to have in your lease that the renter is actually responsible for the property taxes, which in reality they are. It's part of the
100%.
rent. Yeah,
100%.
That's what the rent goes towards.
Yes, 100%.
And they have to sign the homestead exemption card, and that was turned in every year, and then that landlord could get the exemption for that particular house. Well, now they've changed it where it has to get notarized. They actually have to write a check, I think it is, or that's how they're asking for it to be done. And so they've made it a lot harder, but it still is possible.
It is.
It's more of a burden.
I was trying to attack it again recently, and I was like, okay, if I'm going to do this and go through all these hoops, I want to make sure it's done right. So I actually have my attorney
Oh, good.
making sure with the county that this is exactly what we need to do, and this is how it needs to be worded in the lease.
Yeah.
Because I just don't want to,
Do it
because
all.
last year I did it all.
Uh-huh.
He went to turn everything in. They said, we changed it for this year.
Ah.
So I put in the hours of work
Yeah.
and going to the tenants and everything to then have to go back to the drawing board.
Yeah.
So I want to make sure it's worded
That's good.
perfect
Yeah.
because
But if you can get it, if you got one property, if you got one rental property and you get it, that's $500 or
it
so.
is. It is.
But
Yeah.
you got
no, it's huge.
100. Now it's only for single family
Right.
family homes. It's not for apartment buildings. But
Right. It is a huge benefit,
Yeah.
and over the years I've used it as once they've hit that criteria of being there for that amount of time that is needed, I've said, here, sign this, no rent increase
yeah,
this year because I'm going to get this benefit of maybe $30 a month on average.
That's how we can keep it
and
low.
so I won't raise your rent because now I get this benefit,
yeah.
which is just crazy that they're making it harder because this is only a Macon County thing. This
Okay,
isn't like
something they put in.
Yeah, from what I'm reading,
Yeah.
it's not a statewide thing. That's why the form is a Macon County
Yeah.
form. They're making it harder, and it's just kind of
hurting the
frustrating
renters.
because now now it can hurt renters.
Yeah,
Now I'm sure that there's the situations where they're going to get their rent raised by a landlord either
True.
way, but
yeah,
at least the way I know you and I run our businesses, if that expense gets covered by something else, I'm happy to pass that savings
Right.
on to the next person.
yeah. And that is how I was pitching it to them because they have no incentive to sign this stuff.
Right,
It doesn't
right.
do
I
anything for
used
you,
it
but here,
as, hey,
you sign
no
this.
rent increase if you sign this because now you qualify for this, no rent
Yep.
increase on your next lease.
Yeah,
And it worked out great. Everybody was happy.
Yeah.
But now they're making it way harder.
yeah,
And it's not impossible,
Yeah.
but it is a
Which
lot
I-
harder.
yeah. I mean, from their standpoint, they're trying to protect the revenue, and
Sure.
if they are seeing a hit there, I can see that. Yeah, I mean that's really the biggest thing. I guess the other thing too is people really need to know that they can protest their taxes. I know you've done that. I've done that, and what
And best practice, correct me if I'm wrong, is, at least from my experience, has been if you can do it within a year of purchasing the property,
Yes.
that is your number one best way of doing it.
Yeah.
Because if it's assessed for $200,000 and you bought it for $130,000,
easy.
then it's an easy win.
Yeah. Yep.
You might get a little pushback. You might have to go to a hearing, but you're gonna
Usually,
get it.
yeah. So my team and I'm proud of this, is that we have in our process that when we help someone buy a home, we look at the taxes and we make sure they understand, like, hey, the taxes are low on this one. That's probably going to be higher when you buy this. We don't want any surprises. But also, if they're buying it lower than the assessed value, we do all the paperwork. We help them, or at least educate them and say, here's what you need to fill out. Here's what you need to sign. Turn that in now. So the way it works is if it's assessed too high and it's been listed on the open market and goes for lower than the assessed value, and you can turn in a settlement statement and a copy of the listing sheet. They open up the window to hear appeals. I think there's a 30-day window, usually in the October timeframe. But if we have a closing in April,
Yep.
I will help them fill that out, and they can send it in. Then it's sitting there on their stack whenever they go to when the board of review does their reviews in that October timeframe, and that's significant too, because as assessed values are going up, and they should be, assessed values should be going up, but sometimes they're just not correct, based on the condition of the home and the sellability of the home. So people can do that, lower the assessed value. There's a lot of ways to reduce your property taxes, homestead exemption, lower your assessed value. You can go to school board meetings and village meetings and voice your opinion when they're trying to increase the taxes, but that isn't always effective. So protesting your taxes is probably one of the most effective ways. Now, if you own it in an S corp or an LLC, you can't do it individually. An attorney has to do it. I think that's Illinois law. So they have to do it. So for those clients, I can't help them, but I'll say, hey, you should for sure do this one. It's worth paying an attorney to have that done for you.
Yeah, because it's essentially compounding savings.
Yeah.
Once you get that reassessed, I mean, it's not just that 1 year savings. I mean, you're saving yourself money perpetually for however long you intend
Now
on
they're reassessed every 4 years typically, and so it could creep back up, especially if they've made improvements to it, which hopefully you do. But if it was just way high and it shouldn't have been, then it should stay low. Yeah. So tax day, I know this won't come out on tax day, but hopefully it helps people.
Yeah, but still, it's little nuggets for people to think about and hopefully apply to what they're doing and moving forward.
Save some money somehow.
So, save some money. Thanks a lot, Tony. I appreciate you coming on. And thank you guys for listening.